News First at 4 continues.
Welcome back and happy Friday. Greg Harrison from Harrison's Financial Group joins us to talk about why we are seeing changes in interest rates.
The savings and loans crisis of the 1980s revealed the vulnerability of some depository institutions to changes in interest rates. Since that historical market event, U.S. bank supervisors have placed more emphasis on monitoring the interest rate risk of commercial banks. One outcome developed by economists at the Federal Reserve was a duration-based economic value model, or EVM, designed to estimate the interest rate sensitivity of banks. The Federal Reserve's EVM is correlated with banks' interest rate sensitivity, and supervisors can rely on this tool to help assess a bank's interest rate risk. Because of recent structural changes in the balance sheets of banks, regulatory changes in the risk-based capital requirements, and the recent adoption of mark-to-market accounting changes, interest rate risk remains an important issue for commercial banks. Interest rate risk is fundamental to the business of banking. Changes in interest rates can expose an institution to adverse shifts in the level of net interest income or other rate-sensitive income sources, impairing the underlying value of its assets and liabilities. Examiners review an insured institution's interest rate risk exposure and the adequacy of effectiveness of its interest rate risk management as a component of the supervisory process. During the past 12 months, the banking industry has sustained a well-forecasted series of measured increases to the target federal funds rate. Generally, changes in the Fed funds rate will affect other short-term interest rates, such as a bank's prime rate, foreign exchange rates, and less directly, long-term interest rates. An inverted yield curve, where long-term rates are lower than short-term rates, can present a most challenging environment for financial institutions. An inverted yield curve is associated with the potential for economic recession and declining rates. Given recent rising rates and the flattening of a yield curve, bank supervisors have been monitoring trends in bank net interest margins and balance sheet composition rather closely.